What if I told you that some wealthy people don't try to eliminate debt? In fact, some of them deliberately borrow millions of dollars. At first, that sounds completely backwards. We're taught that debt is bad. Pay off your credit cards. Pay off your car. Pay off your mortgage. Don't borrow money you can't afford to repay. And for most people, that's good advice. But here's where things get interesting. Not all debt works the same way. There is debt that takes money out of your pocket, and debt that can potentially help you acquire something that produces more money. A wealthy investor might borrow money to buy an apartment building. A business owner might borrow money to expand a profitable company. An investor might use a mortgage to acquire an income-producing property. The debt itself doesn't create wealth. What matters is what you do with the borrowed money. So how does this actually work? And why can the same financial tool that destroys one person's finances potentially help another person build wealth? Let's break it down. Imagine two people each borrow $100,000. Person A borrows the money to buy a luxury car. The car doesn't generate income. In fact, it comes with insurance, maintenance, fuel, depreciation, and interest. The person now has a monthly payment, but no new source of income. That's what we could call consumption debt. Now imagine person B borrows $100,000 to help purchase an asset that generates income. Maybe it's part of a business. Maybe it's a rental property. Maybe it's equipment that allows the business to produce more. The borrowed money is being used with the expectation that the asset will generate enough economic benefit to justify the cost of borrowing. That's fundamentally different. But there's an important warning here. Borrowing money doesn't automatically make you wealthier. If the asset performs badly, debt can magnify the losses too. And that's one of the biggest things people misunderstand about leverage. The financial term you'll hear repeatedly is leverage. Leverage basically means using borrowed money to increase the amount of capital you can control. Here's a simple example. Imagine you have $100,000. You could buy a $100,000 asset outright, or perhaps, depending on the situation and financing available, you could use your $100,000 as part of a larger purchase and borrow additional money. Now you're controlling a larger asset. If the asset increases in value or produces income, your return on your own capital can potentially be higher. But there's a catch. If the asset loses value, your losses can also be magnified. That's why leverage is a tool, not a magic wealth formula. A hammer can build a house. It can also destroy one. The result depends on how it's used. Real estate is one of the clearest examples of how wealthy people can use debt. Imagine an investor wants to purchase a property worth $500,000. Instead of paying the entire amount in cash, they may use financing and put down a portion of the purchase price. Now, suppose the property produces rental income. That income can potentially help cover operating expenses and debt payments. Over time, if the property performs well, the investor may benefit from several sources of return. Rental income, potential appreciation, and the gradual reduction of the loan balance through payments. But notice something important. The investor didn't become wealthy simply because they borrowed money. They acquired an asset. The debt was simply part of the financing structure. If the property sits empty, if expenses rise, if rents fall, if interest rates increase, or if the property falls dramatically in value, the debt doesn't disappear. The payments still have to be made. This is why sophisticated investors pay close attention to cash flow and risk before taking on leverage. It's not just real estate. Businesses borrow money constantly. Imagine a company has a product that is already selling successfully. The company wants to expand. Maybe it needs new equipment. Maybe it needs another location. Maybe it needs inventory. Maybe it needs technology that can increase production. If the business has strong economics, borrowing money to expand could potentially allow it to grow faster than it could using only its existing cash. Here's the basic idea. Borrow $1, invest it into something productive, generate more than the cost of borrowing. That's the theory. But reality is much messier. The business has to generate enough cash to make the payments. If the expansion fails, the debt remains. That's why responsible businesses don't ask, "How much can we borrow?" They ask, "How much debt can our cash flow safely support?" That's a completely different question. So is there really such a thing as good debt and bad debt? It's not always that simple. But here's a useful framework. Debt becomes more potentially productive when it helps you acquire or build something that can generate income or long-term economic value. Debt becomes much more dangerous when it's primarily funding consumption you can't comfortably afford. Consider a credit card. You borrow $5,000 to buy a television, clothes, restaurants, and vacations. The things you bought don't generate income, but interest continues accumulating. Now compare that with borrowing money for a business investment where there's a realistic plan for generating cash flow. The two situations aren't remotely identical, but there's another critical factor: the interest rate. Even an asset-producing investment can become a terrible deal if the borrowing cost is too high. If you're paying 20% interest while the investment realistically has little chance of producing a comparable return, leverage could work against you. That's why wealthy investors aren't simply looking for debt. They're looking for productive debt at a manageable cost and risk level. Here's another concept that surprises people. Suppose someone has a relatively low-cost loan and owns assets that they believe can potentially generate higher long-term returns. They may decide not to immediately pay off the entire loan. Instead, they might keep some capital invested. Why? Because paying off debt gives you a guaranteed reduction in the amount you owe, while investments carry risk. The decision becomes a trade-off. For example, should I use $50,000 to eliminate debt? Or should I keep some of that money invested while continuing to make the required payments? There's no universal answer. It depends on the interest rate, taxes, investment risk, cash flow, time horizon, and the person's overall financial situation. And this is an important distinction. Wealthy people don't necessarily avoid debt. They understand the cost of debt. They understand the potential use of debt. And they understand the risks. Here's a simple way to visualize it. Two people walk into a bank. Both receive $100,000. Person 1 buys something that loses value. Person 2 buys something that they expect to produce income. Both have debt, but their financial situations can develop very differently. Person 1 has debt to expense, to depreciating asset. Person 2 potentially has debt to productive asset, to income, to potential wealth creation. That's why simply saying debt is bad is incomplete. Debt is a financial contract. Its impact depends on what you borrow, how much you borrow, what it costs, and what you're doing with the money. And perhaps most importantly, whether you can survive if things don't go according to plan. Leverage has an ugly side. It can make successful investments look spectacular until they aren't. Imagine an investor buys an asset using a significant amount of borrowed money. The asset rises. Everything looks great, so they borrow more. The asset rises again. They borrow even more. Eventually, they're highly leveraged. Then the market falls. Suddenly, the investor still owes the bank money, but the asset is worth less. Everything looks great, so they borrow more. The asset rises again. They borrow even more. Eventually, they're highly leveraged. Then the market falls. Suddenly, the investor still owes the bank money, but the asset is worth less. So what's the real lesson? It's not, go borrow money, and it definitely isn't, debt will make you rich. The real lesson is understanding the difference between borrowing to consume and borrowing to build productive assets. Before taking on debt, ask yourself, what am I buying? Does it produce income? What is the interest rate? How much will I pay in total? What happens if my income drops? What happens if the investment loses value? Can I still make the payments? And perhaps the most important question, would I still be comfortable with this decision if things went badly? If the answer is no, the leverage may be too aggressive. The wealthy don't have a secret type of debt that ordinary people can't access. They have something more important. They understand that money is a tool. Debt can finance an asset. Debt can finance a business. Debt can accelerate growth. But debt can also magnify losses, destroy cash flow, and turn a small mistake into a financial disaster. So don't copy what wealthy people do on the surface. Don't look at someone borrowing millions and think, I should borrow money too. Look underneath. Ask, what are they borrowing for? What produces the cash flow? What is the cost of the debt? And what happens if their plan fails? Because the goal isn't to have more debt. The goal is to own more productive assets than you owe. That's the difference between using debt as a tool and becoming trapped by it. This is capital theory, where we break down money, wealth, business, and the financial ideas that shape how people build and lose fortunes. Subscribe for more.